Here's a number that should bother you. 42% of retail investors lost money to emotional trading decisions in the past 12 months. Not to a market crash, not to a recession, not to a trade war or a geopolitical crisis, to their own brains. The average loss was $1,606 per person. That's real money. That's a car payment. That's a vacation. That's a semester of textbooks. And it's entirely preventable. Let's talk about what the data actually says about emotional investing, because the research in 2026 is clearer than it's ever been. The biggest threat to your portfolio isn't the Federal Reserve. It isn't inflation at 4.2%. It isn't the conflict in the Middle East or the uncertainty around AI stocks. It's the person staring back at you in the mirror. Start with FOMO, fear of missing out. MarketWise surveyed just over 1,000 U.S. retail investors in May of 2026, and here's what they found. 64% of investors describe themselves as rational, calm, calculated, the kind of people who make decisions based on data, not feelings. But 48% of those same people made a FOMO-driven purchase in the past 12 months. They bought an asset that was hitting all-time highs because everyone else was buying it. The numbers get worse the younger you are. 63% of Gen Z investors made a FOMO purchase, 51% of millennials, 41% of Gen X, even 20% of baby boomers. The gap between how we see ourselves and how we actually behave is enormous. We think we're rational. The data says we're not, and FOMO is only half the story. The other half is fear. 25% of investors panic sold during a geopolitical event in the past year. A war, an election, a breaking news headline. They sold in a panic, locked in their losses, and then watched the market recover within weeks. The same survey found that 42% of investors lost money to emotional trading decisions overall. The average loss was $1,606. But here's the thing about averages. Some people lost a lot more. Some people lost everything they'd put in, and the people most likely to trade emotionally are the ones who can least afford to lose. Gen Z investors, who have the smallest portfolios and the longest time horizons, are the most emotional generation. 26% of them self-identify as emotional investors, compared to just 13% of baby boomers. The people with the most time on their side are the ones making the most emotional decisions. The research on why this happens is fascinating. And it's not just theory. These biases have been measured, ranked, and quantified. A study published in Qualitative Research in Financial Markets in June of 2026 tested 4 cognitive biases against each other: overconfidence, loss aversion, regret aversion, and something called the Barnum effect, which is the tendency to accept vague, generic statements as personally meaningful. The researchers built a neural network to rank which biases had the strongest influence on investment decisions. Regret aversion came in first at 87.1%. Overconfidence was second at 82.2%. Loss aversion was third at 82.1%. The Barnum effect trailed at 65.5%. Think about what that means. The single strongest force driving investment decisions is the fear of making a choice that might later feel like a mistake. Not the fear of losing money, the fear of feeling regret. Investors would rather do nothing and watch their portfolio drift than make a decision and risk being wrong. That's why people hold losing stocks for years. That's why they skip opportunities that would have worked out. They're not lazy, they're paralyzed by anticipated regret. And the research shows this is stronger than loss aversion, which is the famous finding from Kahneman and Tversky that losses hurt twice as much as gains feel good. Regret aversion beats even that. Another study, published in the Advanced Journal of Econometrics and Finance, looked at how multiple biases combine to create market anomalies like bubbles and momentum effects. The researchers focused on overconfidence, loss aversion, anchoring, and herd behavior. They surveyed over 400 retail investors, financial advisors, and fund managers across several emerging markets. The regression model explained about 38% of the variation in investment decision quality. That's a reasonably strong result for behavioral research. Overconfidence was the strongest predictor of poor decisions, with a negative effect of negative 0.42. The more confident an investor was, the worse their decisions tended to be. Herd behavior followed closely at negative 0.39. Anchoring to past prices was negative 0.35. Interestingly, loss aversion actually showed a small positive relationship with decision quality. A moderate fear of losses might sometimes encourage more cautious, thoughtful choices, but overconfidence and herding were clearly destructive. The interviews with financial professionals reinforced the numbers. 13 out of 15 experts identified emotional investing as a persistent problem. One advisor said, and I'm quoting, "Clients panic sell during dips even when the fundamentals are solid." 11 mentioned overreaction to news. Most retail investors chase headlines, not value. 10 pointed to anchoring on purchase price. Investors hold because they want the price to return to what they paid. 9 flagged confirmation bias, the habit of seeking out information that supports what you already believe. When you already own a stock, you look for reasons to keep owning it. When you don't own it, you look for reasons to stay away. So what do you do about it? The research points to a clear answer. Structural solutions beat willpower every time. When the experts were asked what actually works, 12 out of 15 recommended investor education about cognitive biases. 9 supported the use of robo-advisors. 8 endorsed pre-commitment techniques like setting fixed asset allocations in advance and never deviating. The Stanford Graduate School of Business published a study this year that tested whether AI could help. The researchers asked 1,000 people to write prompts describing their financial situation, then fed those prompts into large language models and simulated the lifetime outcomes. The results were striking. The AI nudged people toward the kind of habits that economists have been recommending for decades: spending less during working years, building a buffer stock of savings, investing in the stock market, gradually shifting to safer assets later in life. Most simulated users over age 30 accumulated meaningful savings, and many retired with over $1 million. In contrast, about 40% of the people who wrote the prompts had less than $10,000 in savings in real life. The AI wasn't perfect. It struggled to adjust spending after income shocks like job losses. It recommended drawing down retirement savings too slowly, and the quality of the advice depended heavily on the quality of the questions people asked. People with low financial literacy wrote prompts that conveyed less information and got less personalized advice. Following that advice left simulated users nearly $50,000 poorer by age 60. But the overall direction was clear. Even imperfect structural guidance beats human impulse. Here's the practical takeaway, and this is the most important part of the episode, so pay attention. Number 1. Automate your contributions. Set up a monthly transfer from your checking account to your investment account on the same day every month. You never have to decide when to buy. The decision is made. Number 2. Set a fixed asset allocation and rebalance once a year. Pick a percentage of stocks and bonds that matches your risk tolerance and your timeline. When stocks go up, sell enough to get back to your target. When stocks go down, buy enough to get back. This forces you to sell high and buy low automatically without having to predict anything. Number 3. Pre-commit to your strategy. Write down your investment plan. Include the specific conditions under which you would change it. A market drop of 20% is not a reason to change your plan. A change in your life circumstances is. Number 4. Recognize the biases. When you feel the urge to buy something because it's going up, ask yourself if you would buy it if it were going down. When you feel the urge to sell because the news is scary, ask yourself if you would sell if the news were calm. The answer is usually no. Number 5. Use the tools available. Robo-advisors, target date funds, and even basic AI tools can remove emotion from the equation. The Stanford study showed that even imperfect automated guidance outperforms human impulse. The data is clear. The biggest risk to your portfolio is not the market. It's the gap between how rational you think you are and how emotional you actually are. 42% of investors lost money to their own emotions this year, $1,600 on average. That's the cost of not understanding how your brain works when money is on the line. The good news is that the fix is simple. It's not about being smarter. It's about building systems that make the smart choice the easy choice. Automate, rebalance, pre-commit. And remember that the most dangerous thing you can do with your money is trust your gut when your gut is scared or greedy. That's financial literacy, not luck.